Welcome to Trends with Benefits, an award-winning podcast by Van Eck with a forward-looking perspective. We explore new ways of thinking about the markets, work, and life. Here's your host, Ed Lopez.
All right, Axel Merk, welcome to the show.
Good to be with you, Ed.
Everybody and to the regular listeners, I am speaking with Axel Merk. And in this special episode, this quick episode of Trends with Benefits, I wanted to catch up with him to talk about the gold market. What else? I'm sure we could talk about a lot, Axel, but I think you're one guy that's really keyed into the gold markets and trends in the space. And so I'd love to catch up with you about that. And, other things that might be on top of your mind, I'd love to get into as well. But something that I've been following and reading about is central bank buying in the gold markets and trying to understand that in the context of gold prices even, and how to think about that as an investor. Generally, from what I've been reading, it seems that central banks around the world have been buying a lot of gold. And some more recent reports that I've seen on Bloomberg have mentioned that buying has been even greater than it's been reported. But what do you make of that?
Well, I think to start out with, I think sometimes it's good to take a step back and just remember that gold doesn't change. Gold just is. And that's kind of the beauty of it. I sometimes call it the best reflection of the mania of our policymakers, because, of course, the price of gold changes. And we get to talk about it from all kinds of angles, but we like it because it's a static. And some people say, oh, it's not a productive asset. Why would you hold it? Well, you hold other non-productive assets. It's a part of a diversified portfolio, something you consider. You're pointing to central banks. Of course, that's in the context that, especially on the U.S. retail side, appetite has been somewhat lukewarm. And yet the price of gold has not just held up, but actually done quite reasonably well in the context of central bank hikes. And we can talk about that. But to address your question about central bank buying, well, just as retail investors, institutional investors and whatnot are diversifying, it appears that central banks are diversifying. And why do they diversify? Well, historically, they hold a lot of U.S. assets, U.S. treasuries, and they continue to do so. But at the same time, if you are somewhat hostile to the U.S., you have come to the realization that the U.S. has become more willing to use financial sanctions to put a wrench into any non-obedient country, so to speak. And historically, that was off the table, but we're inching closer to where that might be reality. And so if you are a country that's not so friendly to the U.S., you might want to diversify a little bit, and the marginal buyer dictates prices. And that's, I think, what we're seeing. That's kind of one of the key drivers as to why central banks around the world are increasing their gold holdings.
You're seeing a lot of reports about China really increasing, having a voracious appetite for bullion. And I guess a lot of that, to your point, stemmed from the Ukraine crisis, right? Where you got to see how the U.S. pulled the world together to implement various financial sanctions on Russia.
Yeah, of course, one of the things is that these sanctions, as they of course all have unintended consequences. Amongst others, other central bank buying more gold, there are probably more severe ones that come to daily lives, but just focusing on gold again, right? I mean, the Chinese are an interesting example because they are struggling to boost their economy. And one of the ways you could, at least not long term, but in the short term, could boost your economy is by debasing your currency, in which case, of course, you wouldn't want to buy gold. But the Chinese are most reluctant to do that because their paramount goal isn't so much economic growth, but social stability. And they're trying to square a circle that ultimately is going to be very interesting to watch. And hopefully it's just something we have to watch rather than being more directly affected if things fall apart over there in China. But yes, diversification in China is part of that roadmap. And what's the sanctions in Ukraine are almost certainly a contributing factor to their motivation.
In addition to setting a country up to prepare against financial sanctions or things of that sort, or be a little bit more independent from the global financial order, if you will, is there something else going on? I mean, I just only saw another headline on this. I haven't really dug into this, where the Dutch central bank has also been buying a lot. The Dutch central bank said they're prepared to go back on the gold standard. Are they also anticipating a financial crisis around the globe?
Yes, as we speak, that headline has been making the rounds. Keep in mind that the reason why central banks in the West in particular have kept their gold holdings, despite being off the gold standard, We hear that in various variants, but basically it is a just in case scenario, because all this fiat money system, as wonderful as it is, according to many, but certainly not all, there has to be a fallback option of sorts. And so I think that's the context in which one should look at that. What I'm pushing back against is the notion that some are advocating that certain countries, and the Netherlands is one of them mentioned there, are just going to get out of the system and create their own gold-backed currency. The reason I'm pushing back against it is because we have to keep in mind why countries got off the gold standard in the first place. It's because they love to spend money. And what better way to spend money is than to print it? And if you adhere to a gold standard, you can't do that. And so these are wonderful theories. I tend to encourage people that if you believe in a gold standard, have your personal gold standard and consider whether that's worth it. But don't trust the government to take care of it for you. That's not going to happen. And also, if I'm not saying we're not going to necessarily not have a crisis. I actually think if we're on an unsustainable trend, we almost certainly will at some point. But on the one hand, don't underestimate the ability of policymakers to push the can down the road. And also, there's always a day after. And so look at Latin America. They have a big mess there. There's always something else there, right? And there are implications, social implications, including the rise of populism and whatnot. But the world is changing. Gold is steady. And yes, there's this desire to go back to gold. But I think we're far, far way off before major countries are willing to go back on a gold standard, because that would imply drastic changes in how they govern. And I don't see that happening at this stage. We've been going further and further away from the gold standard, living in a less and less stable world, rather than going back to something that would be stable.
So what do you make of the individual investor or the investor's lukewarm appetite for gold, just judging by, say, flows into gold exchange traded funds, for instance, or say relative to central banks?
Well, historically speaking, I think there are three major types of gold investors. The one concerned about the purchasing power of the currency, the one that look at diversification, and the third one is the speculator. The speculator will come back if and when there's a huge trend up or down, but they prefer to be in other stocks. And if you look at the diversifying investor, I think those are around. In 2022, diversification didn't work so well. 23, diversification is again working well. And so we have seen those sort of investors nibbling. The ones concerned about the purchasing power do look at real interest rates as well. And of course, as central banks had finally started to raise rates, real rates were moving higher. And so now the question is, what will happen going forward? Prices are always forward-looking. And there, I don't think many people are to blame if they're on the sideline. The higher for longer strategy of the Fed is not a strategy, it's a tactic. They don't know what they're going to do. Nobody knows what's going to happen after. Everybody thinks kind of what should happen, but they will be late. They'll probably be causing more harm because just of the decision-making process, that they're going to be late, and that they're petrified to repeat the stagflationary period of the 70s. And so some investors are looking ahead to the time when they have to start easing, but others are on the sideline. And so this is, it's happening in a good market, right? There are people on all sides of things, of the story. I think the good news for the price of gold is that it has held up despite the rather high rates right now. And then, of course, the question of what's happening on the tail end. There are two scenarios. Either when the easing finally starts, that it's going to take off. That's what many gold bucks are thinking. I wouldn't rule out entirely the scenario that while there is going to be an increase, it's going to be far more modest, because it has already preempted some of that because the price of gold, quote unquote, should be lower given the high rates. And the fact that they're not, maybe they're not going to raise quite as much. And to just put in a word on gold miners, we see that on the junior miners, they did react to the much tighter financial conditions. And I think those will only react once the easing will come in earnest, because then the financing will become better. And the good news in that is the gold miners might be able to take off without a significant rise in gold prices. But that's a very speculative environment, obviously a little bit different from the typical investor in gold.
So you think that when rates start to come back down, that would help buoy the equities of the gold miners?
Well, the more junior players in particular are credit plays. And historically, when you're a recession, the gold miners do take off, conditioned on central banks actually easing, or at least indicating that they will ease. And so this higher for longer environment has held them back. And so I do think that once they do decide, well, and that can happen either because the economy slows down. So, by the way, I think the Federal Reserve will say, we're not really easing. We're just going to lower rates to keep real interest rates from rising. So but at that stage, I do think that the juniors will benefit quite a bit. The more senior companies, the bigger players, the majors, they are so unlevered, so cash flow positive that they're much less of a levered play to gold than they have been in the past. So there the dynamics are slightly different. But again, that area is a highly speculative corner of the markets, whereas people historically buy gold more for defensive purposes. So as much as and we manage both, but it is indeed, it's a little bit different type of an investor that buys the gold, buys the physical versus the mining stocks.
What do you make of the retail investors going into Costco to buy gold bars and Costco selling out?
Well, when I saw that headline at first, I tried to go to Costco and find it. And I punched in a bunch of different zip codes on the East Coast, the West Coast, middle of the country. I couldn't find a single place that actually had it. That said, and of course that was consistent with the story that said that they sell out very quickly.
Do you think Costco is a good place to go buy it? Or, I mean, not to put them on, not to make you comment on Costco, but like I'm surprised they wouldn't just go to another gold dealer or something.
Well, I mean, do you go to your local bookstore or do you go to Amazon? I mean, it's you want to go to a trusted source, and they of course Costco is a trusted source to some people, right? I'm not getting investment advice, I'm not going to tell people to stay out of Costco. And as you're well aware, we are somewhat biased because we manage a gold ETF as well, but there are many different ways. And just like anything, right? Just as we're getting our story out as many different channels as possible and try to be where consumers are, so do those who sell gold. And we want to be in front of people where they shop. And if Costco is the place to be, good for them.
Gold can be a volatile asset, and the different types of ways you might want to play, whether it's through the equities or through the bullion itself. And if you're buying it to diversify and hedge against some kind of risk out there, financial system risk or what have you, I got to imagine one of the questions that you get asked a lot is like, how much do you put in your portfolio? Or maybe how do you think about sizing an allocation to bullion in your portfolio?
Well, first on volatility, gold historically is about as volatile as equities are, but there are periods where it can be far more volatile. And I think when I look at allocating to an investment, I always think about it in terms of risk, at least as much as opportunity. Can you afford the risk that something goes down in price? And the upper limit of that is if you can't sleep at night anymore with that investment. I'm not talking about the physical gold bar being too hard under your pillow, but that you start to be concerned about that the volatility in the portfolio is going to affect you. So personally, I probably have a far more substantial allocation to gold and gold mining than most people have. But I've been able to afford that allocation, and I really enjoy having that. If you do any historic studies, the allocation should be quite substantial. But if you do it on a forward-looking basis, people always say, why should I hold gold going forward? Because it's a non-productive asset. And so we can't give specific investment advice as to the allocation, but you want to analyze your portfolio as to what sort of diversification that you're seeking, and keeping in mind that especially the traditional asset allocation, like a 60-40 allocation, as on the equity side in particular, is very much skewed to a few large cap securities. So I would encourage anybody to think about buying the quote unquote market. How diversified are you? Once you take that into account, you might be willing to have a big allocation to other areas, including gold.
Excellent. And finally, what's the biggest thing that investors should watch in terms of the gold markets?
What they should watch, they should take a deep breath and not be too nervous. They should think about what risks they can take, what they would like to have, and then not be rattled by the latest and greatest news. If policymakers came to their senses and believed in sound money suddenly, they should get concerned, because then there will be real competition from cash. In the absence of that, I think you need to ride out the volatility, think in terms of ounces more than the price of gold of what you hold, and then keep it as part of the diversification. And to just make it, we talk about diversification. The price of gold has a zero correlation to equities in the long run, but it doesn't mean it's always uncorrelated. The correlation is morphing, it's going in and out, as it does with most asset classes. The one thing that price of gold is maybe most correlated to is longer term real rates. And I realize that many gold bugs in particular don't believe in long-term rates. The TIPS yield, the inflation protected securities yield on a 10-year, what can that possibly mean with regard to long-term inflation? But what these signals indicate a confidence of the market in the ability of central banks to manage inflation. And so watching these measures, which do affect the price of gold quite directly, I think is a worthy exercise. But again, the question is one of horizon, right? I mean, what I say here isn't really of much help to the day trader, but if you're a longer term investor, you want to tune out some of the noise and think about why you're holding gold. Do you own enough or too much gold? And if so, how does that work? And what's the impact on your portfolio in the long run?
Very good. Axel, thank you very much for your time and your insights on the gold markets.
My pleasure.
And thank you for tuning in to another episode of Trends with Benefits.